All right, everybody, here we are, Chapter 7, talking about specifically savings. And that's the topic here. As far as learning objectives and things we need to talk about, there's a relationship between investment risk and return that we have to remember. Basically, the higher the risk, the better the return. If you want safety by taking lower risk, you can expect a lower return to come along with that. We'll come back to that theme a couple times. I will talk about the importance of emergency funds, talk about ways to create those funds and where to keep them. We'll do some talking about IRAs, in particular Roth IRAs, and then there's a fair amount of material here on savings bonds. And then we'll talk about some custodial and beneficiary accounts, how parents can, well, typically that's going to be the use that parents are trying to help out their children. There's a couple tax advantage ways that make sense to think about there. And then finally, the one of the most interesting parts of this chapter, in my opinion, is talking about financial fraud and strategy to protect against them. So we'll get to talk a little bit about all those things. First, the idea of risk and return. So the basic idea is this: if you're willing to take more risk with your money, you should be able to expect a higher return. And it should make sense, right? Otherwise, if you weren't getting a higher return for taking on more risk, you would select a lower risk alternative, right? So if you're going to select low risk alternatives, you can expect that the returns will be limited in some way. The only way to get a better investment return is to take more risk. And there's a bunch of different types of risk that we deal with when we talk about investments. You can invest in certain securities or certain options that don't return as much as inflation does. In other words, if you keep your money at the bank, there is a possibility that the interest rates are not greater than inflation. And what that means over time is that you're losing purchasing power. And so that's one of the reasons where if we're trying to maximize returns, we probably wouldn't want to limit ourselves to insured investment options. If you are going to take a little bit more risk, you decide that you want to buy stock in a company, let's say. What if that company goes out of business? Well, that's business risk. And if you're going to invest in individual stocks, there's not much you can do to avoid that possibility. The best you can do is to diversify. And that's the argument for diversification, is if you invest in a bunch of different businesses, it doesn't hurt you so badly if one of them does poorly. Interest rates could increase, and when that happens, your existing investments returns don't look as good anymore. So that's interest rate risk. We have liquidity risk. Sometimes you have an investment, you'd like to sell it, and there isn't anybody who wants to buy it. That's liquidity risk. One of the things that people underestimate about investing in their own homes is that you have a significant liquidity risk. So some people will advocate the strategy of using additional funds that you have to try to pay down your mortgage. And the thought is, well, all right, whatever your mortgage rate is, then that's what you're earning as a rate of investment. The trade-off that people don't usually think about is what it does to liquidity. So great, you've paid off your mortgage, you own your home free and clear. What if all of a sudden an emergency happens and you need access to a large amount of money? You end up with some sort of serious illness, and your only option that you have is an experimental treatment that doesn't accept your insurance. And all of a sudden you need $25,000. Where are you going to get that? Well, all right, if you've got your house paid off, that might seem like a source of investment funds, but the only way to get that money is to be able to sell the house. Alternatively, to refinance, which would be a possibility here too, but then you're undoing all the work that you've done to pay it off. So there's liquidity risk in some types of investments. Well, to be fair, all types of investments have liquidity risk. It's just ranked from high to low. Some investments have more than others. When we talk about returns, it's important to take into account inflation. And this slide makes it look mathematically really complicated to account for inflation. It's really not that bad. And it's interesting that we've got a suggested return here, and then we're just using nominal terms to talk about the difference. So for an example, if you earn 1% from savings in a bank account, and then prices increase by 3%, that's really a negative 2% return. You've lost 2% of your purchasing power because inflation was 3%. Prices have gone up 3%. You only earned 1 on your investment. So you're behind. You've lost purchasing power when that happens. And then down here with a more mathematically complicated example, they're telling you that the nominal rate of return was 12%, inflation rate was 3%. Well, normally I would say the way to calculate that is just to look at the difference. So if you earn 12%, but inflation is 3, then your inflation adjusted return would be 9%. And it's true that the technical way to do that is to divide, like explained in this example here. But notice what you end up with. Instead of 9%, you get 8.74%. I would argue that 99% of the time those two numbers are effectively equal, right? When does a 0.25% of interest really make a difference? If you've got a really long time horizon on a really large investment, I suppose it's possible, but outside of that, they're pretty close. So it doesn't have to be quite this difficult. So if we've got a relationship between risk and return, how do we go about assessing that risk? Well, sometimes you have numbers, and you can do that. That's considered objective risk. We can look at the history of the bond market and the history of the stock market and compare their historical returns. We've got numbers, and we can objectively say that the stock market is riskier than the bond market, and by how much. You don't always get to do that when you're evaluating different stock investments, for example. Some numbers you have could guide your decision. You could look at the earnings of two similar companies over the past 10 years, and then you're using numbers, and you could use that as a way to assess risk. But part of it is going to be subjective. Somehow we have to evaluate each company's opportunities. Somehow we have to evaluate their capability to meet those opportunities, and that's going to involve subjective judgment. And so there we call that subjective risk. We've mentioned before in an earlier lecture about the difference between subjective and objective risk. But the key idea is that objective risk is using numbers. We can measure it. So when we talk about saving and investing, normally when we're thinking short term, we call that savings. And when we're thinking long term, we call those investments. So if you're trying to save for your child to attend college, that sounds like an investment to me. If you're trying to provide yourself a comfortable retirement, that sounds like an investment to me. If you're trying to create a fund that would insulate against the possibility of you losing your job, that sounds short term. That sounds like savings. The same idea, though, we're trying to build wealth. It's just, is it for the short term or is it for the long term? And in reality, most people are going to be using aspects of both. When we do save or invest, we want to be able to maintain liquidity. And liquidity is the idea, how quickly could we turn these investment assets into cash? And so when you're talking about a savings account, well, that's highly liquid. You could just go to the bank and make a withdrawal. Stocks are less liquid, although today that's a little bit easier to sell and to turn into cash. That might you place your order with your brokerage firm, and they'll convert that to cash. You might have to wait a day or so to access your funds, but slightly less liquid. When you talk about maybe you've invested money in a small business that you run, that's not very liquid. That's going to be extremely difficult to turn into cash if you needed to for whatever reason. Same thing if you've paid off the mortgage on your house. Now you own your house free and clear, that's great. But if in terms of liquidity, that's going to be a difficult thing to turn into cash. So we really can rank these things in terms of not only how liquid they are, but how risky they are. And so on level 1 here, we're talking about types of investments that have pretty low risk and consequently pretty low returns, relatively speaking. So yeah, savings accounts, right? You put money in the bank, it's insured, right? The federal government is insuring bank accounts up to $250,000. So as long as you don't have more than that in a bank account, you don't have to worry about any risk that comes from that bank going out of business. You still do have an inflation risk because it's possible that your earnings won't exceed inflation, and then you still have that risk to face there. But you don't have to worry about the loss of principal. As you go up the ladder here, when you're starting to make promises about how long you're going to tie up that money, for example, with a certificate of deposit, that's how that works. With a bank, you're going to tell them, I'll keep these funds on deposit at your institution for 3 years. And in return, they will give you a higher rate of interest than what they're paying on their savings accounts. Still pretty safe because it's still insured. Now you've restricted the use of those funds, though. You've made a promise about how long you're going to keep them tied up. And if you violate that promise, you take that money out early, there will be an interest penalty that you'll pay. We start to look at well-diversified mutual funds. Well, now you're taking on a little bit more risk because stocks are going to be subject to the risks that are inherent in the business cycle. So there are times when the economy does well and times when the economy does not do so well. In the times when the economy is not doing well, the value of stocks could very well drop. So you are subject to the potential loss of principal. The thought is if you're willing to tie up those funds for a long period of time, that risk is a lot smaller. And so it's thought that as long as you're diversified and you've got a long-term time horizon, the level of risk that you're dealing with is fairly moderate. It goes up when you're looking at individual stocks because now your money is tied to the performance of a specific company. And should they do poorly, well, your entire investment could be at risk. So generally, we think individual stocks contain more risk than a typically diversified mutual fund would have. And then consequently, you would expect a higher return from the individual stocks because they contain more risk. At the highest level, we have types of investments that are thought to be a little bit more volatile. So commodities, something like gold or oil, those prices don't grow steadily like we expect stocks to do, for example. Those can fluctuate all over the place. Collectibles, two words will encapsulate the risk here: Beanie Babies, right? Go ahead and invest in those things if you want at your own risk, and you're taking on a high level of risk, so we would expect that those types of investments should be associated with a high level of possible return. So one of our short-term goals, savings goals, is going to be to establish an emergency fund. The idea of the emergency fund is, hey, there's things that just happen that are unexpected that all of a sudden we have to finance out of pocket. A major appliance breaks down, that happens all the time. Your car breaks down, needs to be fixed, that money's got to come out of somewhere because that's a necessity for you to survive in daily life. So where do you go to get the funds to pay for that? That's why we need to have an emergency fund. You could lose your job. And that's why financial planners will say, well, really one of your first goals upon graduating and getting your first full-time job, one of your first goals should be to build up at least 3 months of savings to cover your expenses in case you lose your job, in case you get injured and you can't work. Those are situations where emergency funds are going to come in to be useful. The more stable your job, the smaller that emergency fund can be. But in general, 3 months for a stable job would be a good-sized emergency fund. 6 months for a job that's maybe less stable, where we have less certainty about being able to say, I know I won't lose my job. Either way, you do need an emergency fund, and we can measure how adequate it is by calculating what's called an emergency fund ratio. This is something that comes up on the end of the chapter exam that you have to take. How do you calculate an emergency fund ratio? It's easy. We take your monthly living expenses and we compare them to the assets that you have in your emergency fund. So if you had $3,000 in emergency fund and $1,000 worth of monthly living expenses, your emergency fund ratio would be 300%. And that would indicate that you could survive 3 months off the assets that you already have. Here's just a graph showing some common emergency expenses. So back on that idea of the emergency fund ratio, if you've got cash in a savings account totaling $7,500 and your monthly expenses are $2,500, well, in this case, your emergency fund ratio is going to be 3. 7,500 divided by 2,500 is 3. So it's not a difficult concept to understand. We're just comparing how much you have in savings to your monthly expenses, and that will tell you how many months you can survive on your savings. Of course, if you're going to set money aside in an emergency fund, that means you can't spend it on other things. And that's the concept of opportunity cost. The formal definition is it's the loss of the benefit that you would have received by choosing another option. And sometimes that's quantifiable and sometimes it isn't. For example, if I'm putting money into an emergency fund, I'm not investing it in the stock market. Maybe over the last year, the stock market had a 10% return, and in my bank account, I only earned 1%. Well, in that case, we can quantify the opportunity cost at 9%. Could have earned 10 in the stock market, ended up earning 1. Opportunity cost sounds like 9%. More often, it's subjective. So I put $1,000 into savings, and that means that by definition, I couldn't use that $1,000 to take a vacation. Well, all right, how much did that hurt me? What does that cost? We don't really have a number way to figure that out. That's subjective, but that cost is real. Anytime you spend money on anything, that's money that you're not spending on something else. And that's a factor that needs to be considered. So if you're thinking about saving, you're thinking about short term and you're valuing liquidity very high. the ability to turn that asset into cash quickly is something that you care about with savings, because when you need the money, you need it now. So what options do you have for a savings fund? Well, we could set up a savings account at a bank. And again, we've got $250,000 in federal deposit insurance guaranteeing that even if the bank goes out of business, my deposit will be protected. When you have a savings account, it's fairly easy to access funds. A money market account pays a higher rate of interest, but it's going to restrict your ability to withdraw a little bit. It's common for money market accounts to say you can't make more than 6 withdrawals in a month, for example. So it's a little bit more restricted. Same insurance applies, and you might get a higher return on the money that you deposit than you would get from a savings account. Sometimes we also have minimums that are higher. In other words, where you could open a savings account for a small amount of money, you might need a higher amount of money to participate in a money market account. It's only slightly less liquid, and that's because of the limited number of withdrawals. Some other options. If you're willing to tie up your money for a longer period of time, you could buy a certificate of deposit or a CD. That's what we call that. And they'll have these in various lengths. You could have a 3-month CD, a 6-month CD, a 1-year CD, 5-year CD. You start to get to 10 years, that's pretty long. But all of these options are here for you if you're willing to tie up your money that long. If you promise to tie up your money with the institution that much longer, well, that's going to result in higher return. And you will be able to access your money if you need it. It's just you'll have to pay a penalty and forego some interest if you need it sooner than the promised time period. In other words, you set up a 6-month CD and you make a withdrawal 3 months from now. You might end up losing interest there as a penalty. Another way to do this is a really similar account would be a dedicated savings account. You can read more about that in your book. So here's some of the differences here. Basically what you're seeing is as you start to accept more restrictions, the rate of return edges up. Here's some matching questions that you can go through if you like. I see the answers are on the next page. So you can look at that if you want to distinguish between those 4 different types of accounts and that one concept of opportunity cost. When we talk about saving on a longer term basis, now we're talking about investing. One of the ways that you can save for retirement is using an individual retirement account. Normally we'll tell people the first option that you want to consider is going to be a employer-sponsored plan, because a lot of times the employer will match the contributions that you make, and that's free money. So sometimes it makes sense to consider the employer plan first. If you don't have an employer-sponsored retirement plan, or if you just haven't got to that point yet where you have a job that has that benefit, you can use individual retirement accounts. You don't need an employer to be involved. You can do this yourself and still gain some of the similar tax advantages, even though you won't get a match from anybody for participating in these. If you choose an individual retirement account, so that's an IRA, there's 2 different flavors. Hinted at this before. So we have traditional IRA and a Roth IRA. With a traditional IRA, you get an immediate income tax deduction. In other words, if I made $50,000 this year and I put aside $5,000 in a traditional IRA, they would tax me as if I had earned $45,000 this year. So I saved $5,000 on income tax today. Then that money is invested, it grows tax deferred, and then in the future, when I take money out, I'll have to pay income taxes on that at that point. With a Roth, we flip the timing of the tax benefit. So up front, if I made $5,000 deposit into a Roth IRA in a year where I earned $50,000, I would still be taxed on earning $50,000. But if I put it in a Roth IRA, it'll grow tax-free, and then at the end, when I'm ready to retire, it can be taken out with no tax liability at all. So it's just a matter of when do you want the timing of your tax break to take place. And most of the time we say, well, look at your tax rate now, look at what you expect your tax rate to be in the future, and that'll give you a hint as the direction you might want to consider. For young people starting their career, most of the time the advice is to think about the Roth IRA. And the reason is when you start your career, your earnings are probably lower than they will be in the future. And that means your income tax rate is low. Because remember, we've got a progressive income tax in the U.S., right? The more you make, the higher the percentage that you pay. So would you rather pay it now when your tax is low And then maybe upon retirement, when your tax rate is higher, that might be a good strategy to choose the Roth IRA. That's the one that lets you do that. If you're mid-career, maybe you've peaked on your earnings and you expect your earnings to be lower in the future at retirement, then you might be better off with the traditional IRA. Get your tax break now and go ahead and pay taxes in the future if you expect that they're going to be lower. The book focuses a lot more on the Roth IRA here because of the second condition down here. The money that you're taking out of a Roth IRA, you don't have to worry as much about penalties. In a traditional IRA, if you take money out before retirement, except in the case of certain hardship conditions, there's a penalty. With a Roth IRA, because you didn't get a tax break up front, we generally don't see those penalties when you take that money out. So it gives you a little bit more flexibility. So here's the withdrawals and when they're allowed. The money that you put in, remember, that was not tax advantaged. You had to pay taxes on that. So that's your money. You take that out anytime you want, and there won't be any additional tax implications. On the earnings, well, that hasn't been taxed yet. So if you leave that in there for retirement, which is one of the qualifying withdrawals, then you won't pay taxes at all. If you take it out for some other reason, you'd have to pay taxes on the earnings. But you wouldn't pay taxes on the principal, the amount that you contributed. So that gives you a little bit more flexibility than what you'd have with a traditional IRA. So right here's your qualifying withdrawals. Either you're at retirement age, or you have a couple other conditions that are going on, or your account's been open 5 years. Once that happens, then you can take distributions and you don't have to worry about taxes or penalties. With a traditional IRA, it's a lot more restricted. If you take money out before the age of 59 and a half, then you have to pay a penalty tax, and then also your withdrawals are fully taxable. So that's one of the risks that you take. Which should you choose? Most financial planners will tell you have a little bit of both. Most employer-sponsored plans are on a traditional tax basis. Not all. Some employer plans allow you to use the Roth tax basis to make your retirement plan contributions within the employer plan. Financial planners will say it makes sense to have a little bit of both. So there's two decisions that you're making when you're establishing an IRA. One is how much money you want to set aside. The second is where do you want to invest those funds? And so here are your options to talk about where would you like to invest your IRA dollars. You can put IRA dollars in the bank if you want. The problem that you have here, it's safe, it's insured, and those are good, but that's depressing your return. And what you're thinking is with retirement money, you have a very long time horizon. And so the thought is if you have a long time horizon, you can afford to take more risk in the hopes of getting higher returns. And so that's why most financial planners will tell you with your retirement account money, you're tying it up for a long period of time, that's okay to invest in stocks and bonds and mutual funds. Mutual funds are less risky. What a mutual fund is doing, as we've talked about before, you are pooling your money with other investors so that you can get the benefits of buying many stocks. And the advantage of that is diversification. If one of those companies does poorly, then that doesn't tank your entire investment. And so that's why mutual funds are generally going to be preferred for the average person over individual stocks and bonds. If you're a sophisticated investor, you can talk about investing for retirement using individual stocks and bonds. The average person is probably better off staying with mutual funds. Having said that, it's not uncommon for people to choose to make asset allocation decisions where they're mixing up those strategies, where you put part of your retirement dollars into cash and cash-like investments at banks, and then maybe you put another part into stocks and bonds, and then maybe you're being aggressive with some of it and taking a lot more risk in the hopes of getting higher returns. That's called an asset allocation strategy. You're trying to put a certain percentage of your funds into low risk, medium risk, and high risk options, with the thought being that over time that combined approach could lead to higher returns and increased safety. So think through your current life situation. Why would you choose to use a Roth IRA as the type of account for your emergency fund? Well, one of the reasons to think about it is, again, you don't have penalties or taxes to pay when you withdraw the principal, so you've got a little bit of flexibility there. What reasons can we give for choosing some other option? Really, the biggest one is retirement assets should be saved for retirement. And the reason is when you deprive your retirement account of funds, you're hurting your returns over time. that hurts more than any penalty or taxes that you would have to pay when you take money out. So even if you can take it out of a Roth IRA without incurring penalties, without incurring taxes, you're still losing compounding when you do that. And that is something that is going to affect your future retirement if those assets are not replaced in the retirement fund. So it might be wiser to keep your emergency fund as a savings account and have it be liquid. If your Roth funds are tied up in stocks and bonds, you might, if you need the money right now because it's savings, you might have to sell at an inopportune time when the markets have turned down. Normally, we want to leave money in those investment options so we have time for markets to turn around and resume delivering the kinds of returns you were expecting when you made the investment. So another way to save and to have safe savings is to use United States savings bonds. What you're really doing is you're lending money to the federal government, and they are guaranteeing those returns. They agree to pay you interest. They're automatically reinvesting those and compounding the savings for you. The real advantage of savings bonds is that you're typically going to get a higher rate from a savings bond than you would from a bank in a savings account. They're fairly easy to buy, easy to redeem, and they're safe. Bank accounts are insured, but savings bonds are backed up by the U.S. directly with no limit. So that's an additional advantage that you have there. We do have some disadvantages with savings bonds. One is that your money is tied up for at least a year. So if we're really emphasizing liquidity, this might not be the best instrument to get that. Also, if you cash in before 5 years, there's a 3-month interest penalty that you have to pay. So that's similar to what you're going to see with a CD. So it's a matter of comparing the interest rates to determine where your money would be better spent, better invested, better saved. There's a couple different types of savings bonds. The standard type of bonds are what they call Series EE savings bonds. And the difference here with Series I, is that those are inflation protected. So if you buy Series I savings bonds, then your interest rate is unknown, but it's going to be variable based on inflation. And the theory is that that's going to dictate your return, and so that you are protected from the loss that could happen with inflation when you buy a Series I savings bond. Here's some instructions about how you can actually buy them if you want, how that works. Here's some more. Payroll deductions, a possibility. If you're looking at the returns, okay, so here's something that's pretty interesting. We're talking about annual compounding at about 2%. You're making a $500 investment every single year, and after 16 years, you're going to have a little bit north of $9,000, looks like from this graph. Okay, stop and think about that for a second. $500 every year for 16 years. You've contributed $8,000 of your own capital. And then you've got some amount here that's more than $9,000 as your total return. So you have earned almost $1,000 there, but it's not similar to the type of retirement savings that you get using stocks and bonds. There, the interest rates are much higher, and it's more common to see the bulk of the return actually come from compound interest rather than return of principal. Here, the opposite is the case. 8,000 of your somewhere in the neighborhood of 9,000 is coming from the contributions that you've made. And so that's different. On the flip side, the returns are lower because it's less risky. It's safer. There's a lot more protection here when you're backed by the full faith and credit of the U.S. government. So here we're talking about should you buy an I bond, should you buy an EE bond? If you care about inflation, well, then you'd be more likely to purchase an I bond if you were worried about high rates of inflation, because those will protect you from that. Brand new topic that the book brings up here. They talk about minors owning assets. And we do that through what's called a custodial account. And there's a bunch of different types. This is one way to make sure that minors are able to own assets, even though they're under the age of 18 and legally can't sign contracts. So we've got some rules here about how when you establish one of these custodial accounts, what happens. With a custodial IRA account, and with all our custodial accounts, once a person reaches the age of 18, that's their property, their money, their assets. They can do what they want with it. So this is only necessary in a period of time where you're dealing with somebody who's not over the age of 18. Here's some information on taxation about how that works. IRAs, just like all other IRAs, you have tax-deferred growth, and that's one of the advantages of a custodial IRA. The other one is that the minor automatically becomes the owner at age 18. Most of the time when minors are ending up with assets, it's usually through a custodial account that results from a gift or a transfer. You're giving stock, or you're making an IRA contribution on behalf of the child, or you're setting aside money for college. Um, when you do that, it's possible you can get an income tax benefit for doing that, depending on what it is exactly that you're financing. And it's possible also to delay the capital gains tax hit by strategically using these kinds of accounts. And so that's another reason to think about it. If the ultimate goal is to transfer money to your children, for example, then it maybe makes sense to use some of these custodial account strategies instead of waiting until the time of death to transfer assets. This way we can plan it a little bit and take advantage of tax benefits. Whereas the other way is there's a lot more uncertainty about the time of asset transfer, and we don't really have as much of an ability to plan for those types of things. When we talk about college savings plans, a couple big advantages here is you usually get tax deferred growth on the earnings. So every year you're potentially earning interest. You don't have to pay taxes every year on the interest. It's growing tax free. If there is going to be a tax situation that'll happen when those assets are sold, then if it's actually used for educational expenses, there won't be any tax implications, and so you end up getting those earnings entirely tax free. When we talk specifically about how to save for college, in particular, we've got a 529 plan. That's common. You'll hear people talk about 529s. They're almost always talking about college savings when they're doing that. The real advantage of a 529 plan, as opposed to one of those UTMAs or UGMA plans that we were looking at earlier, is that the person who establishes the plan retains control of the money until it's actually spent. So you can guarantee as a parent that money actually gets spent on college. So you retain control, as opposed to the other types of custodial accounts where the transfer automatically happens to the minor once they turn 18. Maybe you saved a ton of money for them to attend college and they decide they don't want to go. Well, with a 529 plan, then you can say, then we're going to redirect that money to other uses. And you wouldn't be able to do that with some of the other types of custodial accounts that we have. So that's really the biggest reason to think about a 529 plan instead of a custodial account, because with a 529 you retain control. Switching gears a little, we want to talk a little bit about financial fraud and identity theft, which are two related but different things. Financial fraud is when somebody promises that you'll get some sort of benefit and then they don't follow through, and from day one they intended on not following through. It was misrepresented. Financial fraud is something that affects a lot of Americans. Identity theft is a little bit different in the sense that somebody will go out, take your personal information, and try to use it to gain benefits for themselves. You're not an active participant in that situation most of the time, where in financial fraud, sometimes they need your help to collaborate. A couple different examples of fraud: Ponzi schemes, pyramid schemes, telemarketing fraud. So a Ponzi scheme, the way that works is what you're really doing is promising people high returns. You say, hey, I'm an investment genius, put your money with me and I guarantee you a 15% return. Well, that's historically a lot better than the stock market and a lot better than most of the other types of investments that were out there. And if you could really deliver that, you'd be in high demand. So you start out and you say, all right, I'm going to promise you 15%, and people start sending you money. Well, one way to gain credibility is to use that money to pay off some of the people who first sent you money. So you take money from the new investors and use it to pay the old investors. That's a Ponzi scheme. That's the idea. So we promise people, hey, we're going to get a high rate of return, but in reality, the money's just coming from other people who pay you. And there isn't any investing going on. And so at some point, if all the investors demand their money back, you won't have enough to pay. And then at that point, the scheme falls apart. But there's been a number of these schemes throughout history that we've been able to observe. And when they're of this type, we call them Ponzi schemes. Pyramid scheme, on the other hand, is based on the idea that you're trying to attract, you're selling things and you're trying to get a bonus by attracting other people to do the same thing while they're working under you. It's sometimes hard to differentiate between a pyramid scheme and some legitimate business arrangements. There's plenty of multi-level marketing businesses out there that are kind of structured on this basis, and I would hesitate to call most of them a scheme because in reality, for some people, these systems can work pretty well. To be able to do well, You generally have to be at the top. You have to be one of the first adopters because then you've got a lot more people under you. It gets harder and harder and harder because you simply run out of people. For example, if the goal is, I think there's a slide here coming up that demonstrates the idea of the pyramid here. So this one is based on 6 people working under every person. So as we move levels here, each person needs to have 6 people working under them. And you start to see to support 4 levels with everybody having 6 people under them, you need almost 1,300 people to do that. And as you can see, you start multiplying that by 6 each time you increase a level, and you get to a point where it's just not sustainable. I mean, this number right here is 360 million. You can't support an 11 level scheme with 6 people there because you just don't have enough people. You'd have to have everybody in the US plus a whole bunch of other people willing to do this to support 11 layers on top, each person having 6 people under them. And so where the fraud would sometimes come in is where people are paying money in there, and we're supporting the upper people and telling the lower people that they have to continue to recruit people, and eventually you run out of people. You don't have enough people to be able to make this system survive. And that's an example of a pyramid scheme. So some of financial fraud takes the form of a pyramid scheme, some of it takes the form of a Ponzi scheme where we're using new money to pay off old investors and making it look like we have fantastic returns when in reality we're just transferring money from one person to another. Another place where we run into financial fraud is telemarketing, particularly with the elderly. They're particularly susceptible to telemarketing fraud, sometimes just out of loneliness. So that's a problem, and we know it's a problem. And that happens where somebody misrepresents something with an unsolicited phone call or email. And a lot of times they'll say, oh, I'm offering you a free gift, but it comes with a catch. You have to pay something to get this free gift. And then it turns out there is no free gift, or that it's dramatically different from what was promised. And in the meantime, they've taken your money. So sure, good advice to say, always assume that there's a catch, because nobody ever gives anything away for free, and particularly not random, right? I mean, if you had a benefit that you could give to somebody, is that what you would do? You'd call up a random person on the phone and offer it to them? No, you'd give it to somebody you knew. You'd give it to your friends. If somebody's calling you with something that sounds like it's free or too good to be true, chances are it probably is. And so they've got some rules here. They say, well, don't buy things where the person contacts you. Everything that you buy should come from your request to go out and seek these things that you want. You shouldn't be waiting for people to offer to sell you things. Don't pay a fee to get a prize, because if it's truly a prize, that should be free. You shouldn't have to pay anything to receive it. There's all kinds of investments, pitches that are made, and some of those promises are too good to be true. One of the best ways to protect against that is if you don't fully understand what's going on, that's probably something you should take a pass on. And then hopefully it goes without saying that you don't send money to different countries to people that you don't know. There's so much fraud out there. A lot of it comes in this second category here, that you'll get an email that says, oh, a rich relative of yours has died and wants to leave you money, but to access this money, you have to front some funds. Well, the red flags should be going off there, and you should be able to realize that that's something where you probably aren't going to end up with what's promised. It's a good idea, to always get everything in writing if ever you're going to be transferring money. And you should be skeptical when anybody's making promises about money. And there's a trust element there that you're going to want to make sure is fulfilled. When we talk specifically about identity theft, that's the idea that somebody can just steal your personal information. You're not really involved. They steal your information, they go out, they open new accounts, they buy things, and they try to stick you with the bill. It's pretty common. There's a lot of people who've experienced this. When it comes from a credit card, the good news is you're generally not responsible for those. Even by law, you can't be responsible for more than $50 in a fraudulent credit card transaction. Most credit card companies will waive even that $50 charge. So if the fraud happens by somebody stealing one of your credit cards, that's generally not something you have to concern yourself too deeply with, but it is frustrating to have to replace cards and wait for them to come to you in the mail and things like that. And that's a common thing for people to experience. We're talking 35% of the U.S. has had something like that happen. So it's becoming more and more common. So there's some strategies here about how you deal with that. That's a good one. Don't ever give out your credit card number unless you initiated the call. That's good. Unsolicited emails will sometimes ask for personal information. That's usually a good idea not to comply with those instructions. Reconcile often, every month reconcile it so that you can see if there are any unauthorized transactions on your accounts. It's a good idea to keep a list of your cards and debit cards and credit cards in accounts somewhere, so that if somebody does steal your identity, you at least are able to narrow down which cards are impacted. And if you got to replace them all, at least you know how to do that. Um, Once a year, you're allowed to get a copy of your credit report for free. And that's actually annualcreditreport.com. If you go there once a year, you can get a copy of your full credit report for free. And that's something that's worth reviewing every year. The downside is once you review it, you can't get another free copy for a year. So generally, you want to be prepared to take the time to go through it before you order it. Otherwise, if you just order it on a whim, you won't be able to get another one for free until a year has passed. So that's just one thing I'd talk about. Oh, okay, this is kind of a neat math problem. The population of the United States is 350 million people, roughly. So they're saying if you needed 7 people that started and they were each trying to recruit another 7 people, how long would it take before you ran out of people? So you're just taking 7 times 7 times 7 times 7 and checking each time to see at what point you get above 350 million. Go ahead and do that if you want. I think you get there somewhere between 9 and 10, a factor of 9 or 10. In other words, if you take 7 to the 9th power, I think you have in the neighborhood of 280 million, something like that. But if you take it to the 10th power, then your 280 million becomes 1.4 billion. And all of a sudden, you don't have enough people in the U.S. for this to work. That's assuming that everybody in the U.S. is thinking that this is an interesting opportunity for them to participate in. Obviously, not everybody's going to buy into that. They're just demonstrating this idea that at some point the scheme has to fall apart because you just don't have enough people to support it. I mean, that's the idea there that they're coming to. I think that's a pretty good review of everything that's in Chapter 7 that you can expect to see on the end of chapter exam. So I think you're ready to take it. Go do that. Do the best you can, and good luck. We'll see you next time.